Welcome to the Osborne Moreno Tax Talk. And today we're going to cover Medical Expense Reimbursement Plan, also known as the MERP. So, what is a MERP? It's part of Section 105 of the IRS code, and it's an employee benefit plan. That means somebody needs to qualify as an employee. Problem is, if you run your own business as a sole proprietorship, which includes a single member LLC, a partnership, or an S corporation, you're still considered self-employed and you can't get benefits from the plan. So you have to figure out another way to qualify. So if you're a sole proprietor or single member LLC and you're married, you can hire your spouse. If you're a partner in a partnership, you can hire your spouse so long as they don't own more than 5% of the business. If you're a shareholder or a member of an entity taxed as an S corporation, you don't qualify and your spouse doesn't qualify. We'll talk in a bit how we can work around that. Finally, if you run your business or even just a part of your overall business as an entity taxed as a C corporation, you do qualify as an employee all by yourself. By the way, you can also establish a MERP to benefit family employees who help you manage rental or investment real estate through reporting on Schedule E. If you own a lot of rental houses, for example, you can hire your spouse to help you manage those properties just as you might hire them to manage a sole proprietorship. Just be aware that the same ownership rules apply. And if you and your spouse own properties jointly, you're both treated as self-employed for purposes of the MERP rules with regards to this income. Also, you can use the MERP for family employees other than your spouse. Let's say you're a single mom working as a real estate agent. You can hire your teenage child and use the plan to pay for their eyeglasses, braces, or other medical costs. You can even hire a retired parent to help cover their medical costs. The plan has to cover all eligible employees. You can't just cover yourself or your family and exclude everyone else. However, there are several safe harbor rules you can use to limit coverage. Employees under age 25, employees working less than 35 hours a week, employees working less than 9 months a year, employees who have covered or work for you less than 3 years, and employees who are covered by a collective bargaining agreement. There are a couple of other exclusions for larger employers. MERPs are subject to control group rules, which mean you own one business. You might not be able to set it up for just one of them without covering employees of all the rest. They're also subject to the affiliated service organization rules, which means that, for example, if you own a company with 50 employees, your spouse can't set up a side business and cover the family if more than 50% of their new business income comes from your business. But the fact remains that you do have to cover all employees. So if you have a non-family employees, you can't exclude them under one of these MERP rules. Now, for the benefit, once you qualify, the plan lets you reimburse your employee for all medical expenses they incur for themselves, their spouse, and their dependents. So let's say you're married and a sole proprietor and you hire your spouse. You can reimburse them for all the medical expenses they incur for themselves, their spouse, which means you and your dependents. Now, let's say you've taken what probably would have been a non-deductible personal expense and converted it into a deductible business expense. You're avoiding the 7.5% or 10% floor and itemized deductions. If you pay self-employment tax on your net income, you'd even avoid paying self-employment tax on the money you deduct from the MERP. That's another 15.3% or 2.9%, depending on you and your spouse and your total income. This is especially valuable if you're buying your own health insurance on your state's Affordable Care Act exchange or not. You can already deduct 100% of that coverage as self-employment insurance, but deducting it as an adjustment to income means it's still subject to self-employment tax. But if you deduct it under the MERP, as we just saw, it avoids employment tax as well. But the plan also works even if you have outside coverage from employer, Medicare, or TRICARE. You can wrap the MERP around your primary coverage and use it to deduct copays, deductibles, prescriptions, and other expenses your primary plan doesn't pick up. Let's say you're a consultant and your spouse teaches at a local school that provides your primary coverage. You can hire them to manage your books, establish a MERP, and reimburse them for any expenses the school plan leaves up to you. Of course, you'll need to dot your I's and cross your T's to substantiate your deduction. For starters, you'll need a written plan document or a corporate resolution, which whomever you hire to do your health insurance or run the MERP trust can do for you. You'll need to make sure the benefits you pay are reasonable compensation for the work your employee does. If your teenager stuffs a few envelopes for you, the IRS will have a hard time believing a full set of braces is reasonable compensation for that little work. You'll need to verify the work your employee does in order to establish that the benefits you pay are reasonable compensation. This is a big hot button with the IRS and the tax court. Finally, you'll need to establish a paper trail to verify a payment. This means tracking expenses, of course. It also means reimbursing your employee out of the business or paying their expenses directly out of the business. It's not enough to pay your family's expenses out of personal funds, total them up, and deduct them at the end of the year. A couple of tax court cases have established that you really do need to establish a business link to those expenses. There's no need for outside third-party administrator. The IRS rule states that employees can't self-certify their own expenses. However, that doesn't mean you need to pay an outside administrator to do it for you. The business certifies the employee, and there's no special reporting required unless the plan covers more than 100 employees. There's no pre-funded requirement. You don't have to open a special account like with an HSA or flex spending plans. You don't have to decide ahead of time how much you contribute. There's no use it or lose it rule. You simply pay benefits out of day-to-day cash flow like you would rent or utilities. Plan is just really an accounting device that lets you characterize your family medical bills as business expenses. All Section 105 plan sponsors must file a 720 report to pay patient-centered outcomes research institute fee by the end of July every year. We mentioned earlier that if you operate your business as an S corp, neither you nor your spouse qualify as an employee for the purposes of a MERP. Does that mean you can't benefit? Possibly, but not always. Well, let's look at a couple of workarounds. The first challenge is calculating which strategy saves you more. In most cases, the employment tax you save by operating an S corporation outweighs the income and employment tax you'll save with a MERP. If that's the case, then by all means, keep your eyes on the bigger prize. But what if you want to have your cake and eat it too? Well, in this case, you have two options. The first, consider peeling up part of your business and running it through an entity where you can qualify as an employee. If you're a commissioned salesperson, for example, you might run commissions from one supplier or one line of business through the sole proprietorship and then hire your spouse. Alternatively, you can establish a C corporation to provide services to your S corporation. You'll shift income from the S corporation to the C by contract, then establish the MERP for the C corp to help you as an employee. This arrangement is often called a management company because the C corporation provides management, marketing, or administrative services to the primary operating business. If a MERP isn't appropriate, either because you have too many non-family employees or you benefit more by operating an S corporation, consider setting up an HSA account, a health savings account. These arrangements combine a high deductible plan with tax-free savings account to cover unreimbursed costs without regard to the usual 7.5% or 10% floor on itemized deduction. Qualify, you'll need to start with a high deductible plan. For 2020, that meant $1,350 for single coverage or $2,700 for family coverage. Neither you nor your spouse can be covered by a non-high deductible plan or Medicare. The plan can't provide for any benefit other than certain preventative care benefits until the deductible for that year is satisfied. You're not eligible if you're covered by a separate plan or a rider offering prescription drug benefits before the minimum annual deductible is satisfied. Once you've established your eligibility, you can open a savings account. For 2020, you can contribute $3,550 for singles or $7,100 for families. If you're 55 or older, you can take an additional $1,000 catch-up contribution. You can also probably open a bank-style account with the same health insurance coverage that offers your high deductible plan. Withdrawals are tax-free as long as you use them for qualified healthcare expenses, and you can use them for most kinds of health insurance, including COBRA continuation or long-term care premiums. Health savings account isn't as powerful as a Section 105 plan. You've got to have specific dollar contribution limits, and there's no self-employment tax advantage, but you can still cut your overall healthcare costs because an HSA offers long-term planning advantages too. So you can let it grow and use it for future healthcare expenses. There's one final reason to consider HSAs for retirement medical costs. Most retirement savings plans give you a tax break when you put the money in or when you take it out. For example, traditional IRA lets you deduct the contribution going in, but taxes you on the income coming out. The HSA is the only savings vehicle that lets you deduct your contribution going in and avoid taxes going out. Can you contribute to an HSA and a MERP at the same time? Sadly, no. If you're covered by a MERP, you're not considered to be covered by a high deductible health plan, even though your underlying insurance will qualify for it under the MERP wraparound. So you do have to decide which plan is more valuable, the MERP or the HSA. So at Echelon Financial, okay, redo that. At Osborne Marino CPAs, we focus on tax preparation and tax strategy for business owners. We identify all the tax strategies to help you keep more of your hard-earned money.